The stock market is currently closed today, Saturday, August 1st, 2026. Tesla stock completed its last official regular trading session on Friday, July 31st, 2026, closing at exactly $311.21 per share, which represents an upward move of $2.36 or approximately 0.76% for the day. During that session, the price moved within an intraday range between a low of $301.97 and a high of $315.50, with total trading volume reaching 36.63 million shares, compared to its average daily volume of roughly 47.45 million shares. While that modest green close might give casual observers the impression of a quiet, stable market, the order flow underneath tells a far more intense story. Wall Street analysts spent weeks trying to convince retail investors that the drop from summer highs above $430 down toward the $300 support zone was simply a standard technical correction after earnings. But the reality on institutional trading desks is very different. Large fund managers are not simply taking quick profits, they are actively re-evaluating risk exposure across high multiple growth equities, forcing Tesla stock to prove its operational efficiency before they commit new long-term capital. While individual retail traders jumped onto their personal individual brokerage apps to buy what appeared to be a steep discount, major institutional money was quietly shifting allocation into mega-cap technology balance sheets like Nvidia stock and Apple stock. This gap between retail optimism and institutional discipline is the exact friction point defining the entire market landscape right now. To see how this divergence is playing out across the market, you only need to look at trading activity across the primary retail and institutional investment platforms. Individual investors focused on self-investing through user-friendly interfaces like the Robinhood app or SoFi Invest have consistently treated any move toward the $300 level as an automatic buying opportunity. Within Robinhood stock trading and across various Robinhood investment accounts, Tesla stock continues to hold its position near the top of total daily transaction volume, frequently outpacing retail interest in Robinhood Crypto and Robinhood Cash Management Services. Younger market participants utilizing Robinhood fractional shares, SoFi Investing, and SoFi stocks are operating under the assumption that historical pullbacks always lead to rapid rebound rallies. Similarly, users engaging with SoFi Active Investing and the broader SoFi trading platform have steadily accumulated positions, placing trust in long-term tech upside. However, when you cross-reference this activity with what professional traders are doing on the Interactive Brokers platform, a completely different strategy comes to light. Institutional accounts executing through an Interactive Brokers account are hyper-focused on Interactive Brokers' fees, interest rate spreads, and hedging costs. Rather than simply buying spot shares during pullbacks, Interactive Brokers trading data shows sophisticated funds using detailed option strategies to limit downside risk, effectively betting that price volatility will remain elevated for months rather than resolving into an immediate upward breakout. Understanding why this stock pulled back so sharply from its previous highs requires a rigorous look at recent daily price action, trading volumes, and quarterly performance metrics. Just a few sessions back, trading volume surged past 115 million shares during a single down day when quarterly operating margins fell short of aggressive street projections. Leading up to that report, the prevailing market narrative suggested that auto gross margins had reached a firm bottom and that global price cuts were finished. Reality delivered a sharp wake-up call when the numbers showed that promotional incentives, financing subsidies, and shifting product mix were still weighing on automotive profit margins. That earnings release triggered immediate selling across major asset management firms, including institutional accounts managed through Fidelity Investments and Fidelity Wealth Management. Portfolio managers who oversee large allocations inside Fidelity mutual funds and Fidelity ETFs moved quickly to trim position sizes to manage portfolio risk. Order execution records across the Fidelity mobile app and the main Fidelity trading platform revealed a noticeable surge in sell orders from long-term account holders adjusting the risk balance within their Fidelity IRAs and Fidelity brokerage accounts. This underlying market activity creates a continuous challenge for anyone navigating online investing or browsing major investing sites looking for objective investment help. Wall Street likes to present a simple binary narrative. Either you view Tesla stock as a high-growth software and artificial intelligence power that deserves a massive tech valuation multiple, or you view it as an established car manufacturer that ought to trade at a traditional automotive price-to-earnings ratio. The reality sits directly between those two extreme viewpoints, creating a constant tug-of-war in price discovery. While retail participants continue to invest online through an automated intelligent portfolio or rely on structured models like Schwab Intelligent Portfolios to guide their wealth allocation, the company's baseline operational metrics demand realistic evaluation. The automotive segment continues to account for the primary share of total quarterly revenue, and global vehicle deliveries have encountered stiffer competition in key overseas markets than bullish investors have originally factored into their forecasts. At the exact same time, however, the energy storage division has expanded its deployment of utility-scale batteries at a fast pace, generating steady, high-margin revenue that prevents the company's total enterprise valuation from contracting down to traditional car company multiples. Comment below how many shares of Tesla stock you currently hold in your portfolio and whether you plan to buy, hold, or sell at these price levels. Stripping away daily market sentiment reveals a business model built on vertical integration, proprietary technology, and large-scale manufacturing infrastructure. The core financial engine generates cash by manufacturing and delivering high-volume electric vehicles, selling regulatory compliance credits to competing automakers, expanding its global fast-charging network, and selling utility-scale energy storage systems like the Megapack. Historical financial statements show that when vehicle gross margins comfortably exceeded 25%, equity markets had no trouble maintaining rich price-to-earnings ratios well above 100 times earnings. But as annual production expanded toward millions of units and competing manufacturers introduced alternative options, global margin compression became a reality. Past quarterly earnings demonstrate that while top-line revenue reached record absolute numbers, gross profit struggled to grow at the same trajectory, forcing corporate leadership to focus heavily on software monetization, full self-driving subscriptions, and energy storage expansion to support overall corporate profitability. Looking forward toward the medium and long-term outlook, investors are balancing clear upside catalysts against significant structural risks. The optimistic case for the stock relies heavily on software commercialization, autonomous vehicle technology, and scalable robotics. If full self-driving technology satisfies strict safety requirements and receives regulatory approval across major jurisdictions, the transition from lower-margin hardware sales to high-margin recurring software service revenue would fundamentally shift the company's margin structure. Under that scenario, software licensing and autonomous network fees would generate cash flow metrics comparable to software giants, justifying higher valuation multiples across online investment platforms. Conversely, the cautious scenario centers on sustained automotive margin pressure, slower global vehicle demand growth, and potential delays in bringing lower-cost vehicle platforms to high-volume production. If automotive margins remain constrained while capital expenditures for compute infrastructure and factory build-outs remain high, free cash flow conversion could remain under pressure, leading to multiple contraction across major brokerage platforms. Whether you take a self-investing approach, build long-term positions using SoFi ETFs or SoFi robo-advisor tools, or monitor daily market movements through Robinhood app notifications, managing an investment in this space requires looking beyond short-term market noise. Market expectations frequently swing between extreme optimism and deep pessimism, while real-world operational execution moves at its own steady pace. By analyzing actual daily trading volumes, monitoring institutional capital flows, tracking margin trends, and evaluating core segment performance rather than relying on market hype, you give yourself the tools required to make grounded, rational investment decisions regardless of where the broader market moves next. The reality of this equity remains far more nuanced than short-term price charts suggest. Wall Street expected seamless margin expansion and uninterrupted delivery growth, but reality introduced global competition, pricing pressure, and massive capital reinvestment cycles. Yet, for investors who look past surface-level headlines, the company's growing energy business, software architecture, and